Today we're tackling real estate investing. People often say, just buy it, location, 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 or if they're not making any more land. It often feels like it's all about gut feeling.
Yeah, like it's some kind of art form or just luck.
Exactly. But we're going to challenge that today. We're diving into Frank Gallinelli's work, specifically his idea that real estate investing is fundamentally a numbers game.
Mm-hmm.
Our mission here is to get past the surface appeal, the nice lawn or the new kitchen, and really understand how to do the numbers effectively, how to tell a winner from a loser.
And that's so important. This isn't about some get-rich-quick nonsense. It's about giving you the tools, the framework to actually analyze a property financially. Like Gallinelli says, to read a property's vital signs and judge its health as an investment. It's moving from just hoping it works out to actually knowing the odds, understanding the story behind the numbers.
Okay, so let's start unpacking that. Gallinelli lays out this foundational idea, the 4 ways to make money in real estate. These are like the pillars holding everything up. First up, cash flow.
The big one.
Yeah, the actual spendable cash left in your pocket after you paid all the property's bills.
Yeah.
Like the property's monthly paycheck, right?
Exactly. Money you can actually use.
Then number 2 is appreciation. That's the one most people think of first, I think. The property's value going up over time.
Definitely the most talked about, but just one piece.
Right. Third is loan amortization. This is basically your equity growing because you're paying down the mortgage principal with each payment.
Your tenants are essentially buying the property for you bit by bit.
Way. And finally, number 4, tax shelter. How the property can legally shield some income from taxes.
Through things like depreciation, which we'll get into.
So Gallinelli argues you're not just buying a building, you're buying these 4 potential benefits combined.
That's the core insight. The true investor, as he calls them, isn't focused on the physical thing itself. You're buying the property's anticipated economic benefits, what is called the income stream.
The income stream. That changes how you look at it, doesn't it?
Completely. It's why his big rule of thumb is so blunt. Don't make a decision to buy, hold, or sell based on emotional factors.
Ah, yes, the puppy rule.
If you need that warm and fuzzy feeling, get a puppy. It sounds harsh, but it's about being objective, separating your feelings from the financial reality.
That really sticks with you. Okay, so sticking with financial reality, let's talk negative cash flow, when the expenses are actually more than the income.
Uh-oh.
Yeah, Gallinelli points out this means you are physically putting your own money in each month to cover the difference.
Dipping into your savings.
Right. He says it's not automatically a deal breaker, not fatally flawed. Here's the crucial part. You have to anticipate it.
You need to see it coming.
Exactly. If you do your projections, see the negative cash flow is likely for a while, but judge the overall investment worthwhile, maybe because of appreciation or tax benefits, then you can plan for it. Take it in stride.
But if you don't do the projections,
you get blindsided. Suddenly you're scrambling for cash you didn't expect to need. It's all about knowing beforehand.
Which leads perfectly into the next step, right? Doing the work before you buy.
Precisely. Step 1, do your homework. Gallinelli is emphatic.
Yeah.
Good information will fall into your lap without some effort. You have to be a detective.
You got to dig.
You do. Ask for the actual leases. Don't just take the seller's summary. Verify the rent rates, the terms.
See when they expire.
Good point.
Yeah.
Check the property tax bill. Is there an abatement ending soon? Is a big reassessment phased in? That could drastically change your costs.
Huge difference. Utility bills too, right?
Spot check them.
Yeah. Make sure they seem reasonable. And then the potentially tricky one, ask for relevant parts of the seller's tax return, like Schedule E, which shows rental income and expenses they reported. Sellers might push back on that one.
They might. But Gallinelli's point is you need to be firm but fair. Show them you're serious about verifying the numbers. You are not to be trifled with, as he puts it, regarding truth and accuracy.
Okay, so that's property-specific data. What about the market?
Crucial too. You need comparable sales data. What are similar properties actually selling for per square foot? What's the typical gross rent multiplier in the area?
Gives you context.
And you also need to research local capitalization rates, or cap rates. These tell you what kind of return investors expect in that specific market for that type of property. It's the pulse of the local investment scene.
So you gather all this raw data, then what?
Then comes the financial detective work before you buy. And the central tool here is the Annual Property Operating Data Form, or APOD.
The APOD, basically an income statement for the property.
Exactly. Let's break down the key lines. You start with gross scheduled income. That's the absolute maximum rent you could collect if every unit was rented all year at full price.
The ideal scenario.
Then you subtract a vacancy allowance, also called vacancy and credit loss. This is your estimate for income loss because units are empty or tenants don't pay.
Reality check number 1.
Right. That gives you gross operating income, or GOI. Gallinelli calls this the actual income you expect to collect.
Makes sense.
Finally, you subtract all the operating expenses, property taxes, insurance, maintenance, management fees, utilities, everything except the mortgage payment.
Got it. That leaves
Net operating income, or NOI. This is a really important number. It's the property's profit before you account for debt service or income taxes.
NOI. That's what the property itself generates.
Precisely. And understanding these terms, GSI, vacancy, GOI, NOI, that's the bedrock for figuring out if a property actually makes financial sense.
Okay, so you've got the APOD for your potential property. Now what?
Now comes a really critical step, analyzing similar properties. You don't just look at your numbers in a vacuum. You compare its expense ratios, like repairs as a percentage of income or insurance cost per unit, to the norms for similar properties in that market. So, say the seller's APOD shows incredibly low repair costs compared to similar buildings.
Red flag right there.
Huge red flag. Gallinelli warns you, don't assume you're getting a great deal. Assume something's wrong or missing. Maybe the seller deferred a ton of maintenance.
Or maybe they left something out entirely.
Yes. Like, is the electricity expense just for the units? Or does it include the common areas? Hallway lights, maybe outdoor lighting? If that's missing, you need to add it back in.
You need the full expense picture.
And Gallinelli gives a big warning here about apples-oranges comparisons. You can't use expense ratios from, say, a small 4-unit apartment building to judge a big commercial property.
Totally different operating realities, different types of costs, different scales.
Got to compare like with like.
This actually brings up something Gallinelli points out as a really common mistake for beginners.
What's that?
It's that you get so focused on checking the information the seller gave you that you forget to think about what information might be missing.
Ah, the gaps.
Exactly. He uses this great case study of an apartment building. The seller provides an APOD, but when you dig in, you realize common expenses aren't even listed.
Like what?
Like, maybe there's no line item for professional property management fees because the owner managed it themselves. Or no allowance for lawn care or snow removal, trash removal, advertising costs to find new tenants, maybe legal fees.
Things that you, as the new owner, will have to pay.
Precisely. Or even costs associated with buying, like loan points or closing costs, which affect your initial investment number. Overlooking these missing pieces can, as he says, dramatically skew your analysis of the property's value.
So you have to basically rebuild the budget from the ground up.
You have to reconstruct the APOD based on realistic costs for you, not just accept the seller's potentially incomplete version. Otherwise, you're flying blind.
Okay, that makes sense. Now, all this looking at income and expenses over time brings up another core idea, the time value of money.
Fundamental finance concept.
The idea that, $1 today is worth more than $1 promised next year. Because you can invest today's dollar and earn a return on it.
Time is money, literally.
Right. Appreciation is a good example. The value grows over time, but you only get that cash when you sell, potentially years down the road. So its present value is less than its future value.
Which is why we use tools like discounted cash flow, DCF.
Exactly. DCF tries to figure out the present worth of that whole anticipated future income stream, all the annual cash flows you expect, plus the money you think you'll get when you finally sell the property.
It brings all future money back to today's value.
And timing is everything, right? Getting cash flow sooner is better than later in these calculations. Then there's net present value, NPV.
NPV, taking DCF a step further.
NPV compares the present value of all those future cash flows to your initial cash investment, your down payment and closing costs.
So is what you expect to get back worth more than what you put in today's dollars?
That's the question it answers. If the NPV is positive, Gallinelli says it means you've beaten your target rate of return. The investment, on paper at least, looks like it creates value.
Okay, so we're discounting future cash flows. But what kind of cash flows? There's a difference between actual cash and taxable income, isn't there?
Huge difference. Gallinelli really emphasizes this, cash flow and taxable income. Cash flow is, cash. Real money in or out of your bank account.
You can spend it.
Right. But taxable income is not quite so real. It's an accounting concept defined by the tax code. And the big reason they differ is often depreciation.
Depreciation, the magic non-cash expense.
Exactly. Depreciation or cost recovery lets you deduct a portion of the cost of the building, not the land, from your taxable income each year, even though you're not actually spending cash on it that year.
It reflects the theoretical wearing out of the building over its useful life, 27.5 years for residential, 39 for non-residential, according to the IRS rules.
And there are conventions, like the half-month convention for the first year. It gets detailed. But the point is, this deduction reduces your taxable income, potentially even making it negative.
While your actual cash flow might still be positive, that's a key benefit of real estate investing for taxes.
Definitely. And speaking of cash flow and taxes, you also need solid mortgage calculations.
Got to know your debt service.
For sure. Thankfully, tools like Excel make this much easier now. You can quickly figure out your exact monthly payment, see how much goes to principal versus interest each month.
Which changes over time, right?
Mm-hmm.
Especially with a seasoned mortgage, one that's been paid on for a while.
Yeah, more goes to principal later in the loan. Knowing these details helps you accurately project your real cash outflow and also your interest deduction for taxes.
Okay, so we've got the data. We understand time value, cash versus taxable income. Now, how do we actually judge if an investment is good? What are the metrics that matter?
Right, Gallinelli covers a whole range. Some are simpler, like payback period. How many years does it take for the cash flow to equal your initial cash investment?
Quick and easy, but limited.
Very limited.
Yeah.
Ignores everything after payback. Then there's cash-on-cash return. That's your annual before-tax cash flow divided by your initial cash investment, a popular snapshot.
Tells you what your cash is yielding right now.
Exactly. And there's the growth rent multiplier, GRM, property price divided by gross scheduled income. Gallinelli calls it a basic way to evaluate an income property, good for quick, maybe pre-computer comparisons.
But he adds a big caution, right?
Oh yeah. He says, nothing so basic is likely to be extraordinarily accurate or reliable. It completely ignores vacancies and all operating expenses. So useful for a very rough first pass, maybe, but definitely not for making a final decision.
It's too crude. Okay, what about metrics lenders care about?
Good one. Two big ones there. Debt coverage ratio, DCR, and loan-to-value ratio, LTV.
DCR first. That's your net operating income, NOI, divided by your annual debt service, total mortgage payments for the year.
Right. And lenders want to see that the property's income can comfortably cover the mortgage payment. Gallinelli notes the common requirement is a DCR of at least 1.20.
Meaning the NOI is 20% higher than the debt payment, a safety cushion.
Exactly. It's a primary risk measure for them. Then LTV is simply the loan amount divided by the property's appraised value or selling price, whichever is lower.
How much skin the borrower has in the game.
Pretty much. And lenders are usually stricter with investment properties than primary homes. They might only lend up to, say, 70% LTV, sometimes even lower. They want you to have significant equity invested.
Which ties into Gallinelli's rule of thumb about those no money down deals you sometimes hear about.
He does not like them, calls it bad karma. His reasoning. It automatically means more debt service because you borrowed more, which makes negative cash flow much more likely.
Increases your risk dramatically if anything goes slightly wrong.
Definitely. Okay, moving to more sophisticated return measures. The internal rate of return, or IRR.
The famous and infamous IRR.
Famous and infamous is right. Gallinelli says it's the most widely used and quoted rate of return for real estate and at the same time the least understood.
That sounds about right.
Its big strength is that it is sensitive to both the timing and the magnitude of cash flows. It calculates the single discount rate at which the net present value of all cash flows, inflows and outflows, equals zero. It considers the whole investment life.
So it gives you a percentage return for the entire project, but there are problems.
Yes. Gallinelli details the problems with IRR. The main one is the potential for non-unique results. If you have unconventional cash flows, meaning more than one sign change, like negative cash flow later on due to major repairs after years of positive flow.
The math can actually produce multiple IRR answers. Which one is right?
Exactly. It becomes unreliable. That's why he introduces alternatives like modified internal rate of return and financial management rate of return, FMR.
How do those help?
They address the IRR problem by making explicit assumptions about reinvestment rates. Use a specified safe rate, like for CDs or treasuries, to discount negative cash flows and a separate reinvestment rate, reflecting where you'd actually invest positive cash flows for positive ones.
So they give a more realistic and usually single answer.
Generally, yes. They provide a more stable and arguably more accurate picture of the investment's likely return, especially with complex cash flow patterns.
Okay, that's helpful. What else is in the advanced toolkit?
There's also the capital accumulation comparison, or CPA. This is useful when you're comparing investments that aren't directly comparable. Maybe they require different initial cash amounts, or you plan to hold them for different lengths of time.
Trying to level the playing field for comparison.
Right. CPA projects how much wealth you'd accumulate from each option by a common end date, assuming reinvestment of cash flows. It helps make an apples-to-apples decision between mutually exclusive choices.
Wow, so there are quite a few different ways to measure return.
There really are. And that leads perfectly to Gallinelli's overarching rule of thumb about all these metrics.
Which is?
There's no single silver bullet. No one metric tells you everything or always the best. The smart investor, he says, will understand all these techniques, consider them all, and use the one, or several, that seems best suited to the actual investment decision at hand.
The toolbox analogy.
Exactly. He says, after all, you wouldn't keep just one kind of screwdriver or one-size wrench in your basement toolbox. Do no less with your investments.
Makes perfect sense. Use the right tool or tools for the specific job.
Precisely. Okay, let's quickly touch on a couple more advanced concepts and case studies to see this in action. When you sell, you need to calculate your adjusted basis. Basically, your original costs plus improvements minus depreciation taken.
Right, that determines your taxable gain.
Yeah, your gain on sale is the selling price minus selling costs minus that adjusted basis. Knowing how to calculate this is key to understanding the after-tax profit from the sale.
And for commercial properties, understanding specific building measurements is vital, isn't it?
Absolutely. Gallinelli mentions gross building area, GBA, the total floor area, usable square footage, USF, the space within a tenant's own premises. But crucially, rentable square footage, RSF.
Rentable square footage, that's usually bigger than usable, right?
Often, yes. RSF is what commercial rent is typically based on. It includes the usable square footage plus a share of the building's common areas, lobbies, hallways, shared restrooms. That allocation is determined by the loss ratio.
So tenants pay for a bit of the common space they benefit from.
That's the idea. Understanding RSF and how it's calculated is fundamental in commercial leasing.
Okay, let's revisit that mixed-use property case study Gallinelli discusses, the one with the potentially failing restaurant tenant. How do these concepts apply?
It's a perfect example of needing to look beyond initial projections. Maybe the property was cash flowing positively, but if that anchor tenant fails, suddenly you're facing potentially long vacancy.
Lost rent.
Lost rent, plus you'll likely have to pay significant leasing commissions to attract a new tenant, and maybe offer a large tenant improvement or TI allowance to help them build out the space.
So big unexpected costs hit all at once.
Exactly. Those costs can easily swamp the previous positive cash flow and turn it deeply negative for a period. It reinforces his rule.
Yeah.
Look beyond the numbers as presented and to seek out the story behind the story. What are the risks hidden beneath the surface?
You can't just rely on a simple capitalization of current income if that income is precarious.
Right. You need that multi-year projection considering potential bumps in the road.
What about specialized areas like triple net leases?
The triple net lease, or NNN. Gallinelli covers this as a specific strategy. The name comes from the tenant paying the net property taxes, net insurance, and net maintenance costs, in addition to their base rent.
So the landlord has very few, if any, operating expenses related to that space.
Correct. The big advantages are often financial stability, if you have a strong national tenant like a drugstore chain, a very long-term lease, insulation from rising operating costs, and minimal management headaches.
Sounds pretty good. Lower risk.
Lower risk, exactly. But, and this is key, remember the risk-reward trade-off. Because it's lower risk, Gallinelli points out you should expect a likelihood of lower return compared to properties with more landlord responsibilities and potentially more upside.
So who is an NNN property good for?
Maybe someone prioritizing stability and predictability over maximizing returns. He likens it to a target date mutual fund approach for retirement planning, focused on lack of volatility and preservation of capital, steady income, fewer surprises.
Got it. Different strokes for different folks and different investment goals.
Absolutely. So wrapping this all up, Gallinelli's core message seems pretty clear. Success in real estate isn't really about luck or just having a good feeling or, like he says, scratching a few figures on the back of an envelope.
No quick napkin math.
Right. It's about seriously working the numbers, understanding all these different financial concepts and measures we've talked about, cash flow, NOI, cap rates, DCR, IR, NPV, and knowing how and when to apply them.
Being that financial detective.
Being the detective, absolutely.
And maybe the final thought to leave everyone with comes straight from Gallinelli. The easier it is for you to know and understand your options, the better your decision will be.
That's powerful.
It really is. So keep digging, keep learning these tools, ask the tough questions, and apply this kind of rigorous analysis to every potential deal. That's how you move from hoping to knowing in the real estate numbers game.